Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your headlines. The Fed's hawks are sounding more and more dovish. Eric Rosengren joins the chorus, playing down inflation fears. Stocks look for direction as attention turns to other central banks. The Bank of England is expected to upgrade its near-term outlook. Turkey and Norway also hold rate decisions. And stepping on the gas, VW raises its full-year outlook as a market recovery boosts demand. We hear from the CEO, Herbert Diess, and we'll speak to the auto parts maker Continental this hour. Welcome back to the programme, everybody, to the second hour of the European Market Open. And we've just got 5 seconds or so to go until the start of the European Equity Trading Session for this Thursday morning. And so let's have a look at the futures. And futures suggest we will be moving a little bit higher at the start of the trading day. US futures flat to positive, but actually increasingly positive as we go through this morning's session. So let's get to the start of the European trading day. I can see the FTSE 100 is out of the gates, up by 0.1%. There's a focus on the earnings story, of course. There's a focus on higher commodity prices. I wonder if that's having something of an impact in the London market as the London market opens up ahead of the others. The IBEX in Spain now open up by 0.2%, and the CAC 40 in Paris open to the upside by around 0.1%. So as I say, there's the commodities focus, there's the earnings story to think about. There's also the inflation narrative, and as Mark was telling us in the last hour, inflation seems to be really one of the only things that the people in the Asia market want to talk about right now. And so that is interesting in itself. And we will return to that story in just a moment. We're just getting these markets opening to the upside then. And we see some individual corporates, of course, moving on the earnings stories that they have announced. I can see SocGen up by 4% on the back of their numbers. So that is interesting to watch on the back of a stronger equity market performance from them. Talking of equity markets, so European equity markets moving to the upside. As the world's largest economies recover, investors are increasingly focused on when central banks might start throttling back emergency support. The Fed's Eric Rosengren weighed in on that debate.
We're going to taper if it becomes clear that the economy continues to prove at the pace that most forecasters have. And I'm expecting a very strong economic recovery. Most private sector forecasts are expecting that. Many people are anxious to start spending again and spending in a way that they don't have to be socially distanced. So there's likely to be a surge in demand at the same time that there are going to continue to be supply constraints. And that's going to push up inflation for this year, but we're not expecting that to persist into next year.
The thoughts there of Eric Rosengren. Joining us now, Stephen Major, HSBC Global Head of Fixed Income Research. And Stephen, interesting to hear somebody like the Boston Fed president there talking about his expectations around inflation, having sounded hawkish in the past, saying, yes, inflation will tick up this year, but we don't expect that to sustain into next. I think you're a little more relaxed about inflation than some of the guests I have on this program. Give me your top line thoughts on the inflation threat at this point.
Well, I am. I think it's a temporary phenomenon. It's interesting that so many Fed speakers have been coming out in recent weeks, Anna, and I'm sure the clever people at Bloomberg could probably produce some kind of chart to show it. It's almost as if the yields got to a certain level and the Fed started to push back against where the market had taken the bond market. So I think that this is one of many of the kind of orchestrated comments that have been coming out of the Fed, and by repeating the same message, they're trying to really drive home the idea that something has changed, and they're waiting for the actual inflation to come in, and it's probably going to be many years before they start lifting rates. And that message, I don't think the market has fully understood.
Right, so you don't think the Fed likes yields when they go much past 1.7? I'm just looking back at the chart of 10-year yields. And 1.74, I think, is the recent high we got to. So would you expect to see further, more of this kind of commentary if we were to get back to those levels once again?
Yeah, it seems that the forward yield, so the 5-year rate, 5-year forward, got to above 2.5. And 2.5 is above where the Fed was guiding the longer run dot. So that has consistently over the years been a key level for them. As regards inflation, by the way, everyone's been talking about it. You're quite right. They've been talking about it probably all year. But the market had repriced for higher inflation expectations before the year had started. if you look at charts of break-even inflation and forward break-even inflation, it's barely gone up this year, this calendar year. The big move was last year. The reason yields have been able to go higher this year is because the real yield has adjusted, and that I think is connected to the Biden blue wave, the fiscal push, vaccine rollout, etc. But the inflation was in the price, but people won't stop talking about it. Now, it's not surprising because you've got a big increase in commodity price inflation, big increases in food prices, and anecdotal evidence of supply chain pressure, etc., etc. But we all knew about this, and it's happening, and it's kind of in the price.
Right, and I suppose the nature of temporary is important, isn't it, Stephen? What exactly it means to see inflation pressures being temporary, and what those temporary pressures can turn into. You know, something might start off as temporary, but then have a longer lasting impact and sort of hang around a bit longer than you'd anticipated. I suppose that's a risk for those who don't see it. That's a risk to your view, perhaps.
Totally, and look, stuff happens. So the inflation might go up and then it might stick for a bit. And in previous cycles, you've had interruptions that have given us a big disinflationary impulse. That might not happen this time. But our underlying assumption is that the base effects and the transitory nature start to fade in the second half. And we're back within the kind of 2% PCE level by then. Now, of course, we could be wrong. But the Fed is, don't forget, focused on something quite different to what the market seems to be speaking about. The Fed is acknowledging that they've undershot for about 10 years. They've got some catching up to do. They recognize that they've been too hawkish in the past. They've even contributed to the disinflation of the last decade. So they're prepared to sit and wait whilst inflation overshoots. So the market's pricing in 240, 250 for the next few years. That could happen. And if it's the case that inflation sticks for a bit, then bond yields don't have to go up because they've already incorporated that.
Okay, so that's what you say. When you look at commodity prices on the rise, Bloomberg commodities back at the highest in some 10 years, that's the commodities index, the highest since 2011 at least. And when you look at the year-on-year increase in inflation, in commodities prices, so a kind of measure of commodities inflation, my colleague's talking about that being the highest in 40 years. When you look at that, you just say, well, that's already in the price. We knew that was coming.
We knew it was coming, but also the Fed is targeting something else. It's targeting core PCE, and it's looking at a flexible average. And so I think that people are having these discussions and getting excited with limited information. The full information set has to include the fact that something changed in the way that Fed's looking at inflation. And so, yeah, I get it. There's some upside inflation pressure. Everybody should know that was going to happen. There's a base effect, and there are some supply bottlenecks, and we've had a very unusual time, to put it mildly. And we've had the biggest fiscal stimulus since the last war. So, of course, things are different, and investors therefore need a bit of risk premium to compensate for the unusual circumstances. But that doesn't mean to say we've got a regime shift here and yields are going to keep going up forever and ever. I mean, that they say isn't going to happen. The market's already made the adjustment. So I think that, yes, there's plenty of excitement about inflation, but it's a bit in your face. It's in the news, and bonds tend to look through that kind of noise.
Okay, good to speak to you on that front, Stephen. Stay with us. Stephen Major, HSBC Global Head of Fixed Income Research, staying with us a little bit longer on the programme. Coming up here on the European Market Open, the UK's economic rebound is fueling speculation that the Bank of England will start discussing when and how to taper its stimulus. All of the details next. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to the European Market Open. 11 minutes into our European trading session for this Thursday morning, and the European stock market is actually a little more buoyant than perhaps we had anticipated. US futures improving as we've been through the last hour of our programming. So NASDAQ futures now up by 0.4%, E-mini futures up by a little less than that. Let's talk about what's happening in the UK today, not on the political front, but on the monetary policy front. The UK's economic rebound is fueling speculation that the Bank of England will start discussing when to taper stimulus. The MPC is expected to maintain its target of £150 billion of bond purchases this year, but could begin slowing its pace. Joining me now here in London is Bloomberg's Lizzie Burden. Very good morning to you, Lizzie. So what can we expect from the Bank of England today?
Well, Anna, we can expect the bank to vote to keep interest rates and QE on hold. But what we are expecting to change are the bank's growth forecasts. Remember, back in February, it forecast 5% growth for the year. But since then, we've had a raft of good news. We've had the success of the vaccine rollout, which has allowed the government to loosen restrictions and reopen the economy gradually. We've had Rishi Sunak's budget, which extended government support measures like the furlough scheme. And so as a result, we've seen the resilience of business and consumers, and that's reflected in all the economic data from retail sales all the way through to job advertisements. So put all that together, and Bloomberg Economics sees a pretty significant upgrade to 7.5% growth for the year. But park that for a minute, Anna, because GDP's been swinging a lot during the pandemic. So what investors will be watching perhaps even more closely will be inflation. Bloomberg Economics does see inflation tipping past the bank's 2% target. And if the bank agrees with that forecast, well, one economist I spoke to last week said it would be a super hawkish sign.
A super hawkish sign. And what does that mean about the talk of tapering then?
Well, you know, the recovery is going so well that everybody wants to know when and how the bank is going to end all this stimulus, take its foot off the pedal, if it's going to eke out the asset purchasing programme until the end of the year or taper more abruptly sooner. And if it chooses option number 2, investors are likely to see it as yet another hawkish signal that an interest rate hike is in the pipeline.
Okay, Lizzie, thanks very much. Lizzie Burden joining us there, Bloomberg's Lizzie Burden joining us there with a look ahead to what we expect from the Bank of England. Stephen Major is still with us, HSBC Global Head of Fixed Income Research. How is the UK story playing in with your global narrative then, Stephen?
Well, I guess the UK is an input to the whole story. The idea that the Bank of England could be reducing the asset purchases and therefore moving towards increasing the short rates is making a big assumption that the exit principles are being maintained like that. But it could well be that they choose to taper and then start to run the balance sheet off. I mean, frankly, we don't know. That is an open question. So I think we should be very careful about making assumptions that link the decision on the asset purchases automatically to the timing for the first rate hike. I can say that based on the work that we've done, and I could also say it on the basis that it's an unusual time. So why would you assume that the pattern would repeat from previous cycles? So to me, if rates ever do go up in the UK, they're not going to go very far, and that's the key point.
And what kind of assumptions are you making about the large pot of savings that certainly not everybody in the UK, but on aggregate, the UK has managed to accumulate during this very, devastating, but also very atypical recession and recovery? Yeah. What assumptions do you make about that pot, Stephen, and how it gets spent? Because this is not normal for the emergence from a recession, is it?
Well, I, for one, won't make any assumptions. And as you've alluded to, it depends which strata of the population you're in, because some people may have accumulated some savings or paid down some debt, but some people unfortunately have not. And that's something that is really important. I mean, economists tend to talk about things in aggregate, and they assume kind of homogeneous outcome, and that's not going to be the case. And anyway, this money that ended up with households was borrowed by the government with some help from the Bank of England. So a rational view of this says we've borrowed money from future generations to fund income and consumption today. Why would that be a fantastic thing for economic growth? It just seems to me to be buying some time. So this idea that there's a great big pot of money waiting to be spent, well, I'm not getting so excited about it.
Okay. Interesting to talk to you today, Stephen. Thanks very much for joining us. Stephen Major, HSBC Global Head of Fixed Income Research. Stephen will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. I look forward to speaking to him further then. Just want to get to some breaking news across the Bloomberg. A red headline tells me that the EU is backing the proposal to discuss waiving the vaccine patent protections. You may remember that yesterday in session we heard from the US. They'd backed a waiver of vaccine IP protections at the WTO. This is something that needs to go through the WTO, and the expectation from the US is that it'll take quite a long time to talk about. But here we have the EU presenting its at least willingness to back the proposal to discuss this at the WTO. So we'll look for further lines coming through on that. This coming through from Ursula von der Leyen, who is speaking this morning, and also saying that they will have doses for 70% of the citizens in July. This, of course, vaccine doses against COVID-19. Coming up here on this program, Donald Trump remains banned from Facebook for now. That's the decision of the tech giant's Independent Content Oversight Board. We discuss that next with Hella Thorning-Schmidt, co-chair of Facebook's Review Board. She has a lot to say on this subject. More on that next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Friday is Jobs Day on Bloomberg Television. Will unemployment move lower, and how will markets react? Plus, special guest, Minneapolis Fed President Neil Kashkari. The April Jobs Report, Friday morning on Bloomberg Television and Radio.
Welcome back to the European market open. 20 minutes into our European trading day and making some decent gains across European equity markets after the sell-off 2 days ago and a bounce yesterday. That bounce continues. Now, Donald Trump remains banned from posting on Facebook. That decision was announced by the tech giant's Independent Content Oversight Board. It has also recommended reviewing the status of the former US president once again within 6 months. Joining us now is Helle Thorning-Schmidt, co-chair of the Facebook Oversight Board and, of course, the former Prime Minister of Denmark. Very good to speak to you then, Helle, on this program. So the board that you co-chair has said that it thinks that Facebook is avoiding its responsibilities. Why do you go so far? Why do you say that?
Well, first of all, we are deciding to uphold Facebook's decision to remove Mr. Trump from the platforms. We thought that was a right decision. Looking at the post from the 6th and 7th of January, we felt that was a right decision. And we looked at it from Facebook's own community standards and the human rights laws that they want to abide by. But we also said very clearly that it wasn't right that Facebook invented a new sanction for this particular user, because Facebook has standards, they have rules, and they have to follow those rules for everyone. So they can't just invent an indefinite ban, which doesn't exist in their own rules, and they can't just invent new rules as they go along. So that was basically why we're saying to Facebook, go back, look at this, look at all our recommendations, and within 6 months, look at this case again.
Do you think Facebook is moving quickly enough on this then, Helle? I mean, clearly this is a specific case that you were talking about here, but people have called for a long time for Facebook to apply its rules consistently, to make those rules clear, to have consistent application and to consider the implications of what it does on the political realm. Do you think Facebook is moving generally quickly enough to satisfy all these criticisms?
I actually think that the Oversight Board is pushing Facebook in the right direction. And for example, this decision that we took yesterday will push Facebook to not again invent a sanction that doesn't exist in their own rules. It is very clear that Facebook actually took a good decision those January days, but they then invented this sanction that doesn't exist. And I think with the ruling that we have made here, they will not do that again. And what we have advised Facebook to do is to look at all our recommendations. They will have to answer all our recommendations within 30 days and put them into place. And on that basis, decide again. This doesn't mean there's an automatic way back for Mr. Trump, but it does mean that Facebook has to assess Mr. Trump's account again, and the likeliness that this will occur again, harm will occur again. And on that basis, they have to decide on a sanction that is actually within their own rules.
And who should make all these decisions, Helle? Because Facebook might think that's partly your role as the Oversight Board. The Oversight Board clearly kicks this back to Facebook and says you need to do better. Facebook themselves have made no secret of the fact that Mark Zuckerberg has a lot of sway when it comes to weighing up what should and shouldn't be on the platform, certainly in this particular case. So are there question marks about who actually makes these decisions?
I don't think there is. I mean, the Oversight Board was never created to lift responsibility of Facebook. And that is basically what we are saying here. Yes, we will look at the actual act of removing Mr. Trump from the platform. That was fine. We looked at that very thoroughly and we came up with a decision. But we will not lift responsibility on sanctions from Facebook, and that's why we are pushing it back. But I also think that we've already proved with this decision, but also the ones before this, why it is so important to have the oversight board, because we are no longer in the situation that it is ultimately Facebook deciding on their own content. They have asked us to do it. And before, it was ultimately Mark Zuckerberg deciding what could stay up and what got removed. Now we have the oversight board. We are independent. We don't take instructions from anyone. We can say and do what we want, and we will follow up on both our decisions and our recommendations. So I think with this decision, we are really proving why it is important to have an oversight board. And I think Facebook will never again just invent a new rule as they go along.
Do you think we're getting closer to a time where action is going to be taken by lawmakers in Washington, Helle, to try and limit the protections that Facebook and other social media platforms have under Section 230? This is something that, of course, Facebook has clung to, just as many social media outlets have. Do you think we'll see further regulation of these platforms?
Well, I don't want to speak just as me, not from the oversight board. I'm a former prime minister. I've been fighting for free speech all my life. It's one of the values that I believe most in, because it's giving agency and voice to so many people. And I want policymakers to think hard about what it would actually happen if government started to interfere in what we can put on social media. I can think of many governments who would love to do that. And just look at Turkey, Russia, Belarus, perhaps Hong Kong. They would love to decide what people can post on social media. So we have to be careful not to make rules that would work in perhaps our part of the world, but not in parts of the world where they have less democratic regimes. So I'm very worried about governments wanting to decide content on social media, and I think they need to think twice.
Helle, thank you very much for your time. Good to speak to you. Helle Thorning-Schmidt, co-chair of the Facebook Oversight Board and former Prime Minister of Denmark. Thanks very much for joining us. Important conversations to be had. Coming up here on this programme, we'll be back to talking about the supply chain issues, the latest on how the chip crunch is hitting the auto industry. We'll speak to the CFO of the car parts maker Continental. That conversation next. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour into our European trading session. You can see European equity markets, broadly speaking, on the front foot, up by 0.3% on these stocks 600. Let's get into the sector detail for you, put up those sector moves and show you where we are as US futures also improve over the last hour. So NASDAQ futures up by 0.5%, E-mini futures up by 0.3%. This is the picture we have for you in terms of the sector moves across these European equity markets. Autos and parts to the upside. I can see that's the best gaining sector. We're going to be talking to Continental shortly. We've already heard from VW this morning, and chip shortages not taking the edge off that sector in this morning's trading session, if perhaps it has done in other sessions. I just want to get to another sector and some market reaction we're seeing there. This is the pharmaceuticals sector. The EU is back to proposal to discuss waiving vaccine patent protections. So this is a staging post in the conversation, if you like, around whether vaccine protections should apply around COVID-19 vaccines. I can tell you that we saw some selling in Chinese vaccine manufacturers, excuse me, overnight as a result of the lines coming out of the US on this front. Now we see the narrative moving into Europe, so it seems as if the Europeans are on the same page as the Americans, at least trying to open up these conversations at the WTO. In response, we saw a big drop in the share price of BioNTech. It's just moved a little bit further to the ups. Well, it recovered some of those losses, but you can still see it moving to the downside this morning. So this is certainly something we are watching very closely, this story around IP protection for vaccine manufacturers. Let's get a look at some of the other stocks that are on the move this morning. And Bloomberg's Danny Berger has a rundown of those. Danny.
Yeah, Anna, you've got the pharma sector all covered. I wanted to look at banking sectors because it was that third biggest gaining on the GRR screen you had there. SocGen leading that path higher by more than 6%. A really monster beat when it came to their equity trading. Their highest amount since 2015. Also lower provisions as well. And this is really something we're seeing across the banking sector, perhaps not a beat as large as that. Also learning that SocGen is letting their French staff work from home 3 days out of the week. UniCredit, a very similar story here. It's smaller than its European rivals, but still beating on trading. Also seeing its fees rise pretty significantly as well. But one that's standing out from the pack today, and not necessarily in a good way, is ING. Of course, their model is very different, but they did have lower provisions like the rest of the banking sector. But perhaps part of the reason that the stock is weaker today is that they've been relying on lending, and there just really has not been that demand for lending. Instead, a lot of their consumers are building up deposits. Now, if we want to talk about the other big theme besides banking, as it has been for the past couple of months, it's inflation. So let's look at some of those inflation-sensitive assets. Yesterday, we had the NASDAQ falling, which was odd after that weaker ADP print. You'd think there'd be a bid for growth stocks. It didn't come through yesterday, but today it is coming through, and we are seeing a weaker dollar. So that's a bit of a reversal of some of that reflationary trade we've been getting. But one asset that's still trying to play catch up here with that reflation trade is steel. Anna, you and Mark talked about this earlier today. Steel rebar listed in China, open again after the holidays. This is a 3 standard deviation move, now trading at its highest since at least 2009.
Danny, thanks very much. Yeah, absolutely. A lot of focus on commodities broadly. Steel specifically flashed bright green on the GMM screen as it opened up on the Dalian market, with China returning to the trading fray this week. Now let's turn to the car sector. Auto parts maker Continental issued a new 2021 forecast which excluded its powertrain unit. That's as the company plans to spin off the division in the second half of this year. Continental reported sales growth for the first quarter of the year. That's despite the global shortage of semiconductors that's hitting the autos industry. I'm pleased to say we're joined by Wolfgang Schäfer, the Continental CFO. Wolfgang, good to speak to you. And let me start, if I can, with the semiconductor issues and the shortage there. We've heard a lot about this week. Give us your sense of how much this is impacting on your business at this point.
Well, if you look at research companies which are estimating the effect of the semiconductor shortage on the market for the total year, they think now the number is something around 1.5 million cars less produced than they had thought only a couple of months ago. We are one of the big suppliers of electronic parts and products to the automotive industry, and by that, yes, we are affected. And actually, at Conti, more than 700 people at the moment are working basically 24/7 to just make sure that we get all the parts as much as possible in time to our customers.
So you've got a team working on it 24/7, Wolfgang. That is interesting to hear. Will it resolve itself? Does more need to be done to resolve it? And over what time frame?
While it will not be resolved in the next days, we think the second quarter is seeing the peak of this shortage, but there will be remaining effects in the third and the fourth quarter, probably even until the first half of next year. It's hard to predict, but definitely it's not over now, and we think Q2 will be the peak.
Q2 will be the peak. Let me ask you about the broader raw materials story, or rather switching to the raw materials story, Wolfgang. Supply chain constraints are a feature of car manufacturing in a number of areas. It's not just issues around chips, but other parts of the supply chain as well. How is that affecting your production? Are there issues with any other parts?
Well, we are mainly affected from price variations, price increases at the rubber side of our business. Natural rubber and synthetic rubber show strong price increases, which makes our guidance now include 350 million of headwind from raw material cost increases. Shortage of raw materials, we do have the one or other in other parts in the rubber and in the automotive division, but they are not so significant. So it's more the cost effect for us beside the semiconductor topic than it is supply topic.
You've issued some new guidance this morning, which you just referenced there, Wolfgang. I'm asked by one of my colleagues about your potential for achieving 8 to 11% medium-term targets on EBIT margin. Are you able to give any kind of granular guidance, or is this all subject to the fluctuations in raw material prices?
Now, this is our midterm guidance, and we are on the path to achieve that. You know that we have done measures in our adjustment program for the next years to have a gross positive cost effect of about 1 billion in 2023. This will be a big push for that. And then our order intake is showing to sales increases over the years to come. This will be another effect to help us to get to this margin target, which you just mentioned.
And is the company still on track with the spin-off of Vitesco? I know that you factored that into the guidance you're giving, guidance without the powertrain unit. Is that still all on track? Is there anything that could throw the timetable off course?
Well, that is still on track. Actually, after the annual shareholder meeting approved the spin-off, there is nothing which we need in further approval. So we are just doing the implementation now. We have been working on that for a while, and I'm very sure that we will be ready in a position in September to do the spin-off.
Can I ask you about the demand outlook then? Clearly you supply many of the automakers that are busy trying to turn themselves into electric vehicle manufacturers. What does the demand outlook look like for the battery EVs at this point in 2021? What kind of numbers do you have in mind?
Well, we see a strong demand increase for these type of products, and I'm now not referring to cars manufactured, but to what we are delivering to those electric cars in component, and this was an increase of 65% in the first quarter versus the first quarter of last year. So we see a very strong demand for these type of products.
A strong demand, and what is the outlook then for European auto demand? Clearly you supplied to the automakers, so I wanted to get your perspective. In China and the United States, we saw demand bounce pretty strongly post-COVID. Of course, we've seen extended lockdowns in many parts of Europe. So what is your sense of how quick that rebound will come in Europe? Will it be V-shaped, or will we be lingering below 2019 levels for some time?
Now, we believe that as well in Europe, the markets will pick up stronger than we have seen that now versus the US and China, like you are rightly pointing to. In the second half of the year, we expect already that this is partly increasing, and then for 22, we are as well optimistic for Europe. Still, we believe that Europe will be the market which is developing somewhat weaker versus the United States and North America and China.
Thanks so much. Thanks, Wolfgang. Good to speak to you, Wolfgang Schäfer, the Continental CFO. Lots to talk about this morning. I mentioned what was happening with BioNTech and the share price of that particular business falling this morning. And just to get you the latest details on what is happening there, we have a fall, we're still seeing a fall in that particular share price this morning. It's fallen as much as 19%, recovered a little bit from its earlier lows. But this all coming as we saw Ursula von der Leyen suggesting that her thinking may be in line with the Americans in that they are willing to consider the suspension of these IP protections, intellectual property protections for pharma companies through the WTO. That could be a long process, we heard from the US yesterday, but there is consideration of that now, and you see the share price reaction in this German biotech business. Coming up here on the programme, we speak to the president of the EU Chamber of Commerce in China. That's as the EU's relationship with Beijing is at a low point. More on that conversation post the G7. They had a lot to say about the China relationship. That's next. This is Bloomberg.
You start your morning.
Oh, guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
it's the mix of positive markets which went up, high volatility, but with, of course, no dislocation, so a very organized level, and overall appetite for investors with the reflation trade. So activities also on the corporate side. So a lot of elements were aligned to help us to deliver this strong performance. It might be a little bit slower, but we are confident on the Eurozone. You saw also the PMI index, which was at the highest level since 1997. Services, of course, are more impacted at this stage with the still remaining lockdowns, but vaccinations make progress. And we are, as I've said, positive on the overall rebound of the economies. Of course, the US will also grow very much with a lot of money provided by the government. It will help also Europe, let's face it. So overall, we are more positive on the overall economic environment on a worldwide basis.
That was Frédéric Oudéa, SocGen's CEO, Société Générale's CEO, speaking to Bloomberg after the bank posted its best equities trading revenue since 2015, and that was certainly pushing the share price higher in the early part of the trading day, and it continues to do so. That stock up by 4.7% right now. Now, the European Union says it won't ratify an investment deal with China as long as its officials are sanctioned. The retaliatory actions by Beijing follow EU sanctions on Chinese officials over alleged human rights abuses in the Xinjiang region. The bloc is also strategizing ways to counter state-funded Chinese takeovers. For more on the EU-China relationship, joining us now is our Brussels correspondent, Maria Tadeo, who's standing by with a guest. And I can tell you, Maria, in the foreign ministry briefing we're seeing coming out of China, we're hearing from them that China is willing to stay in communication with the EU on the EU deal. But you take this conversation forward for us.
Yes, Anna, let's just go straight into our guest. That's Jörg Woodke. He is the head of the European Chamber of Commerce in China. Mr. Woodke, we have to ask you about that investment deal. This was a deal that was agreed between China and the EU at the end of last year. We know this was something that Germany in particular was pushing for, but now it seems the EU is not in a rush to ratify the deal. If it can't be ratified, you can't implement it. So what's going to happen here?
Well, we worked 7 years on this deal, and without being cynical, it might be another 7 years until we see it ratified. So it's not dead in the water, but definitely the sanctions, these asymmetric, unwise sanctions from China targeting EU parliamentarians definitely has caused major problems for the ratification process. So China has supposed to lift, first and foremost, of course, the sanctions on these parliamentarians. I don't see this happening anytime soon. So we are in an unfortunate situation of having concluded something and 3 months later, we have to wait again.
Okay, so what we're essentially saying is that your hopes that this is going to go through and be ratified quickly, that's essentially not going to happen. I mean, you're in for potentially years.
Yes, I mean, sanctions are easy to impose, very difficult to lift. Just look at the West and Russia. 2014, 7 years later, nothing has really happened. And I'm very pessimistic about the fact that these sanctions from the Chinese side will be lifted anytime soon. I guess there's some sort of discussion going on, but certainly not for the foreseeable future, unless China makes this major step and lifts the sanctions, particularly on the European parliamentarians.
And, I wonder, what does it mean for European companies? Because the whole point of this deal was to provide a level playing field for European companies. That was the spin, that this was good for European companies. So if there's no deal, what happens to them?
Well, we will not fall through the cracks. I mean, first of all, the background sound is still, 7-8% growth. 30% of global growth in the next 10 years will be in China. And hence, we will just participate as we did over the last decades. But of course, we would have been better off by having more transparency on state-owned enterprises, more accountability on subsidies. There was a little bit of market access possible in there. And of course, we're going to wait for this one. But the background is really you have to be in China, and you have to be in China more than ever. And I guess we will do just that.
And, you know, yesterday the European Commission put out this industrial strategy, and they said, as you mentioned, that state aid was problematic when it comes to China. They also reiterated that the relationship needs to be much more reciprocal. So I wonder what's going to happen to the big Chinese projects like the Silk and Belt Road. Is that dead? Can we assume no European country is going to participate on that anymore?
Well, keep in mind that Europe is building up its toolbox in order to make sure that there's a level playing field in our backyard, because it's very hard for publicly listed companies to compete against state-funded enterprises. But at the same time, of course, we always urge the Commission also to look into their third country connections and relationship, because we are competing against Chinese companies in third markets under this label of Belt and Road Initiative. And there we have lost a lot of deals because, again, we cannot compete against state-funded enterprises. So Belt and Road is something that is actually a bit fading away. I think there has been a lot of awareness around the world that China is not going to throw money at countries, but actually ask for repayment. And you can see it in Sri Lanka, in Montenegro, and other places, how economies are struggling. So I would not put too much into this Belt and Road Initiative scheme. I think actually it's being scaled down from the Chinese side.
And Mr. Woodke, just very briefly, what type of Chinese reaction are you expecting? Do you foresee that this could turn the relationship even more frosty?
Yeah, sure. Political, this kind of tension is always bad for business, uncertainty. Again, you have the case of H&M being chased down the road because of their procurement issue in Xinjiang. But at the same time, my experience over the last 4 years was that actually, despite this Trump-induced tensions on the political side, China went the extra mile in order to safeguard American business interests within China. So American exporters were hit mightily, but the guys on the ground here actually got the whole support from the Chinese bureaucracy. And I can see this already now here. It's like a compartmentalization of this. Politics is one thing, and very harsh reactions from Beijing. At the same time, they want to have more European business here, and they make the extra effort in order to, in particular, attract high tech. So on that side, it looks a bit strange because, you know, big tension, big noise. At the same time, we still have the red carpet here.
Well, Mr. Woodke, thank you so much for your time and those insights and joining us on Bloomberg TV. That was your Woodke. He is the head of the European Chamber of Commerce in China. Anna?
Maria, thanks very much. Really interesting conversation, how the geopolitics plays into the business agenda. Maria Tadeo, our Brussels correspondent there with Jörg Woodke. Thanks very much to Maria for bringing us that conversation. Coming up here on the programme, central banks are in focus with rate decisions from the Bank of England, from Turkey and from Norway. We'll discuss the market outlook with Bloomberg Market Live team member Ven Ram, who'll be with us next. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 54 minutes into our trading session, European equity markets on the front foot. US futures also point modestly higher, up 0.3% on NASDAQ futures right now. Ven Ram, Bloomberg Markets Live, currency and rate strategist, joins us. And Ven, we've got a host of central banks making decisions today, not least of which the Bank of England. What will you be watching for?
Morning, Anna. In terms of the Bank of England, we'll be watching for, there are lots of expectations that they will raise their growth forecast for the year, and there is no doubt that they will do that. What will be of greater interest to the markets is what they say on bond purchases. The current envelope of the bond buying will end sometime in November, early December. So a slowing of bond purchases is necessary if they are going to continue with those bond purchases through the end of the year. And we'll also be watching for any signs of hawkishness, although I don't personally expect it. Anna?
Yes, I mean, globally, we're thinking about inflation, aren't we, Ven? Away from the UK experience, but we're thinking about inflation globally. What are your thoughts on where we've got to, what we've learned very recently about that inflation narrative?
Well, I mean, the Fed officials have repeatedly pushed back on the notion of a taper because they are not particularly concerned about inflation expectations down the line. They've said that, look, inflation is going to overshoot for a short time. And anyway, after the Jackson Hole framework that they unveiled last year, they've moved to average inflation targeting, meaning that the tolerance for above average inflation will be a lot higher than it used to be. So as far as the Fed is concerned, they are thinking that any temporary overshoot of inflation isn't going to be a problem, and they're willing to look through it because, let's face it, in all of the post-war expansion, the biggest, longest post-war expansion that we saw before the pandemic struck, we never got 2% inflation really meaningfully for a long time. And that's the message that Powell has reiterated. Sorry, Anna.
Ven, thanks so much for joining us. Really good to speak to you. Ven Ram from the Markets Live team. Thanks very much for your time. Just a quick mention of one of the themes that's been developing as we've been going through this hour of programming, and that is pharmaceutical companies under pressure. We heard from the EU that they're willing to consider suspension of IP, intellectual property rights, on COVID vaccines. That is something that would take a long time, would go through the WTO. That has had a big impact, as you can see, on the share price of BioNTech, not necessarily on others. We've heard from the European Federation of Pharmaceutical Industries and Associations. They are not in favour of waiving vaccine IP, as you might suggest. We will continue to cover this story for you. Surveillance Early Edition is next.
We're now in the early stages of a sustainability revolution.
The battery problem may be
the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Many people are anxious to start spending again and spending in a way that they don't have to be socially distanced.
We will not come back to something similar to before the pandemic. We will adapt the way to work, and I think it's the right balance, and I think it's going to be very attractive for our staff.
I'm willing to compromise, but I'm not willing to not pay for what we're talking about. I'm not willing to deficit spend.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 6th of May. I'm Francine Lacqua in London, and here's what's coming up on today's program. The G7 puts pressure on China and Russia to behave after the former suspends economic dialogue with Australia. Shares in Shanghai and Sydney slide, while the U.S. looks set to open in the green. The Bank of England is expected to make a big upgrade to its growth forecast while warning that it's ready to loosen policy if needed. The UK also holds regional elections across the nation. And stepping on the gas while VW raises its full-year outlook as a market recovery boosts demand. We hear from our interview with the chief executive, Herbert Diess, about why he's not too worried about the global chip shortage. Well, it's a pretty busy Thursday. Let's get straight to the top market stories with our Danny Berger. Danny, we focus on inflation. There's also a lot of industry sectors, actually, that we're looking at, including chip makers, including, for example, pharmaceutical companies. But underpinning all of this is inflation.
Yeah, definitely. And look, if you were to just ignore this bottom asset, which I have on here, that's copper, you would kind of get the sense that that reflationary trade is taking a break today. Yesterday, we had that softer than expected ADP data. Still, the big growth names sold off. You think that weaker jobs data would mean more of a bid towards growth. Well, we are getting that just a bit this morning. We're seeing NASDAQ futures outperform and a weaker dollar. So again, that's giving back some of that reflationary trade. Not to a huge extent, but that's the way markets are pointing. But still, because of those corporate stories, Francine, because of still those hints of supply chain weakness and other inflation pressures, we're still seeing the commodity industries, the commodity sector just move higher. At one point, copper was above $10,000 in London. We're also looking at steel listed in China playing catch up at its highest since at least 2009. Now, you also mentioned pharma, so a quick look at CureVac and BioNTech with the EU discussing the U.S.'s plan to waive COVID-19 IP. And so we're seeing these vaccine makers, of course, these are the German depositories for these companies, fall as much as 12% for CureVac. At one point, BioNTech was down 19%, so paired some of those losses, but still some pretty heavy selling for these companies, Francine.
Danny, the tech trade also gotten a bit of attention because of what it's done to popular funds like ARK.
Yeah, that's certainly right. Look, ARK is on track to see a very sustained period of outflows. So here I have the daily flows for it, and it's seen 6 consecutive days of outflows. This is more than $770 million coming out of the funds. You think about what ARK has a lot of, this cult favorite. It's a lot of stay-at-home stocks like Zoom. It's a lot of just these big growth names like Tesla, for example. And in this environment where we're getting the U.S. economy opening up again, and we have these high valuations questioned, that's not going to be great for these companies. And so, you know, this is certainly going to be an issue for them. We also have the story of Jeff Bezos selling about $2.5 billion worth of Amazon stock as well, Francine. Not having an impact on Amazon yet, but, you know, that's certainly in the zeitgeist as well.
I know one of the first things that we read this morning, Danny, thanks so much, or Danny Berger there, we're with quite a lot of action from the markets today. Now, top G7 diplomats have singled out China in their communique after talks in London. The statement calls on Beijing to participate constructively in the rules-based system. In response, China urges the G7 nations to stop meddling in its affairs. Well, joining us now to discuss all of this and the markets is our opinion columnist. He's Marcus Ashworth. Marcus, first of all, with renewed tensions in China, how will the market take it?
Well, I think this is a unfortunate long, slow play out. So I think the markets are relatively phlegmatic. I personally don't think to see this is going to be anything untoward, and I wouldn't read too much into it.
So what are you looking into the markets in general, Marcus? I guess underpinning everything is the inflation debate and when we start tapering.
Yeah, exactly. And I think, look, I happen to be quite, I think that most of this inflation is temporary and will pass through, though I clearly understand that it's a very important thing when you see commodity indexes through the moon, that this is one to watch very, very closely. The Fed cannot be more, and even the hawkish people were pretty dovish last night, so they are really trying to get across. This time they will, even though they should be tapering here, by common sense, and likewise, Yellen's comments were perfect common sense. It's just that the message they're trying to get through the markets is that they're going to worry about, particularly U6, which is the, you know, sort of underemployment and also the labour participation rate. Those two types of things. This time, I mean, much more importantly, the Fed is going to take a much slower approach until they see, you know, the weaker parts of the economy really, not just the strong overall performance, which clearly is going to be, but that all the weaker parts are starting to recover as well before they start even tapering, let alone, as Yellen might have said, of having to raise rates. But the clear thing here is that the fiscal side is much more important for the Biden administration. The monetary side is going to fade into the background in the sense that the fiscal stimulus, you know, if that therefore causes troubles in monetary policy and monetary policy will then have to react, then the administration do not care. I think that's a big message that the market has to realize. Before the midterms in 2022, this administration is going to continue to put more and more stimulus in, which means more and more bonds, which means more and more growth, and potentially means more and more inflation.
Marcus, we also have the Bank of England today, and I guess the million-dollar question for markets is, do we have a timeline, you know, well telegraphed from officials from the Bank of England or other central banks that will give the markets enough of a warning when they do start tapering?
Oh, yeah. I mean, I think that it's a chance it could be today. And they tapered this time last year, actually, which everyone seems to forget, and then they sort of changed their mind on it. But the point here is that, you know, this is a real tweak. So from 4.5 billion even, pardon me, a week, it might drop down to, say, 3.5 or 3. I don't think they'll do that today. I think they might do it June, but they're more likely to do it in August. A bit like the Fed, they're going to slightly overdo it, the stimulus, keep it going, and they'll taper it slightly, therefore, more aggressively towards the back end of the year, and they've got the rest of 2021 covered. I don't think they will then do more QE. So I think the first central bank, well, the Bank of Canada's already gone, but the ECB will be last, then the Fed, but the first will probably be the Bank of England, but it won't be till sometime this summer. And I think they'll obviously upgrade growth forecasts today, but I think they'll just say things are looking great, but a little bit too early to start taking the foot off the accelerator.
So, Marcus, looking at the markets, I know you've written quite a lot about CoCos and corporate bonds in general. Is there still value in there? What are people looking at?
Well, I mean, yes, there are. So there's some value. I have to say that. Look, if you think equities are expensive, which they are, though I think they'll carry on going up, bonds are still the most expensive asset class on the planet. And look, there's not a lot of fun to be had there. But if you can get with a decent bank a coupon close to 5%, I can understand, for instance, why the Deutsche Bank CoCos went well. You know that you have to buy some yield. I mean, how people have been making money in the last 2-3 years is extending their duration on the government bond fund and taking extra credit risk. So longer maturities, more credit exposure, lower down the credit scale, and obviously getting involved in new issues. That's how people have been beating their indexes. Can that go on forever? Probably not, but there's no other game in town at the moment. So anything with a half reasonable yield, which is just about acceptable on the risk scale, then people will buy it.
Marcus, overall, I mean, like a day like today, it's interesting because we have quite a lot of bits. You know, we look at, for example, pharmaceutical companies because this talk about intellectual property being waived and being supported by the U.S. We look at what's happening exactly in technology stocks, in commodities, which is not the super cycle maybe that we saw in the past. You know, apart from inflation, is there any one narrative that kind of ties everything together?
Well, I think more of the same. I mean, I just don't think, reference to the China stuff, I don't think the market is in bad shape. Well, nor should it be with this much stimulus in the system. Therefore, really, I mean, keep on buying the dip. No point getting super long right here, but at the top. But certainly, I think the song remains the same: is that equities are in reasonably good shape as the economy recovers. Yes, there's going to be some dislocations, some supply chain bottlenecks, which cause some inflation. But and yes, yields are very low. But the central banks are saying, stick with it. We are constantly going to keep on reinforcing that message until we are super clear that the economies are fully recovered. So, things are set reasonably fair. But like any markets, they can get a bit stale. We know the sell in May metaphor. But I would say on any dip, then it's time to reload.
Marcus, thank you so much. Our opinion columnist, Marcus Ashworth. Now, coming up, the virus crisis worsens in India as hospitals start to overflow. We'll get the latest from our Sam Fazeli next. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's go straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK is set to lift the ban on international leisure travel from May the 17th, but only to a handful of places. Officials are studying the latest data to work out which countries should be added to a new green list of approved destinations. The details are expected to be announced as soon as tomorrow. Meanwhile, the UK has sent 2 military ships to Jersey, as France has sent a patrol ship to meet it. That's amid a protest by French fishermen. It is the latest escalation in the spat over post-Brexit fishing rights. France has threatened to limit access for UK financial services into the EU if its fishing boats aren't treated fairly. And Moderna says early results show its COVID-19 booster vaccines give positive results against new variants from both South Africa and Brazil. But the drug maker says it's worried about even newer mutations emerging from India.
As this data is going to be coming out, we also are seeing strains in India that seem even more ominous than the South African one. And so the question will be, how's that going to fare against these new boosters? Do we need another booster? And look, lest people think that we're going to be stuck in this battle for a long time. We are going to be stuck in this battle for a long time, but at least now we have a weapon to deal with it.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, COVID-19 vaccines are proving to work, as Leanne was just saying, against a new virus strain circulating in India. New variants are likely to emerge, though, in the country as infections keep surging by more than 300,000 cases a day. Now, some experts worry more dangerous mutations may appear in the monitoring blind spot. Well, joining us now is Sam Fazeli, Bloomberg Intelligence's Director of Research for EMEA, focused on pharmaceuticals. Sam, as always, thank you so much for coming on. I have like 201 questions for you. If we start with India, we see these really heartbreaking scenes in hospitals, although no PPE. How much more are we going to see infections rise in India?
Good morning, Francine. The problem with trying to estimate this is the scale of how bad this can get. Is that it's almost impossible to gauge the risk at which people are putting themselves. As you rightly say, when you see people with the inability to protect themselves, and then in a high concentration of people who live in the cities, urban areas, and of course there's the rest of the country too, I can't imagine this can get easier anytime soon with the level of infections that there are there now.
So what's the way forward, Sam, if we're not seeing, and I know it's up to local governments to decide whether they're going to shut down or not, does vaccine, just put inoculations at this time where cases are so rampant, is there a real danger of new, more dangerous variants showing up?
But there's always a danger of variants coming up, and of course the more the virus gets an opportunity to multiply, the more mutations are likely to gather. The problem is that this is a little bit, with vaccines today, is a little bit late to try and get that done. And you actually could possibly run the risk of vaccinating people and giving them a moderate level of immunity at a very high rate of infections, and then giving the virus an opportunity to find its way around the vaccine. The probability of that is low, but I think we have to assume that that's a possibility, because that's what we've been worried about anyway around the world.
Sam, what do we know about, we were just speaking to the Moderna chairman, what do we know about the vaccines that we're using at the moment and how they would be efficient, maybe with boosters, against some new variants?
Yeah, so we know lots of new things today. First, Moderna put out a very nice press release out yesterday showing that their new vaccine, designed against the B1351 variant that was first found in South Africa, as a booster does induce an immune response that's better compared to the previous version of the vaccine. That's great news. I might have mentioned this thing called original antigenic sin, where whatever new vaccine you develop, you still keep getting the immune response to the original version. So that one answers that. And of course, Pfizer's just had data from Qatar showing that the existing vaccine is 100% effective against severe critical disease, even with B1351, the version coming out of South Africa. So those are both really good, strong pieces of data today.
Sam, I mean, in 6 months, 8 months, I don't know how difficult is it to quantify actually mutations. So do mutations kind of go from A to B, or could they go from A to Z, so be widely different? Like, could, at this point, COVID-19, again, get ahead of us and we don't know how to deal with it?
It could. The problem with mutations is that you only know what you've looked at. So, you know, when you're in the UK or Denmark and you're doing lots of genomic sequencing, you have a much better view of how the virus is evolving than in areas where there are possibly 1 million cases a day of infections a day, and you're only sequencing 200 of those. So when you don't know, unfortunately, we go back to the known unknowns and unknown unknowns. We just have no idea how that virus is evolving in India or anywhere else where the infection levels are high. That was the case in the US too. I think we have to just keep a very close eye on this. The good thing is that the vaccine technologies are able to respond quickly.
Sam, the other news, of course, that came out is the fact that the U.S. now proposes, or is behind the proposal of waiving the intellectual property rights for a lot of these pharmaceutical companies. This is good for inoculation, but is it bad for companies in the future because they don't have the incentive to come up with booster shots or things like that?
Yeah, I think we have to go back to a wonderful editorial that Bloomberg Opinion editors wrote just a few days ago on this topic. The patents for these vaccines are published. People can go and read them. I can go and get them and have a read of them. The issue is not patents. The issue is that you've got to have the people who are capable of manufacturing, the devices, the machines, the raw materials. Those are the issues. Just making the patents available and saying we won't sue you if you follow them is not going to really, in my view, change anything. And even if it does, it will be a year before any vaccine manufacturing will be produced, by which time you're again into a different world with regards to variants and the needs for boosters. So I hope it helps. I doubt it will make much difference.
Sam, thank you so much. Sam Fazeli there, Bloomberg Intelligence's Director of Research for EMEA. Now, coming up, the UK's economic rebound is fueling speculation that the Bank of England will start discussing when and how to taper stimulus. All the details next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK's economic rebound is fueling speculation that the Bank of England will start discussing when to taper stimulus. Now, the MPC is expected to maintain its bond purchase target this year, but could begin slowing its pace. Well, joining us now is Bloomberg's Lizzie Burden, who follows economics at Bloomberg. Good morning, Lizzie. So what can we actually expect from the BOE today?
Well, Francine, we're expecting the Monetary Policy Committee to vote to keep interest rates and the QE envelope on hold today. But what we are expecting to change are the bank's growth forecasts. So if you remember, back in February, the bank forecast 5% growth for the year. But since then, we've had a raft of good news. We've had the success of the vaccine rollout, which has allowed the government to loosen restrictions and reopen the economy. We've had Rishi Sunak's budget, which extended government support measures like the furlough scheme. And all of that's meant that businesses and consumers have shown their resilience, and that's reflected in all the economic data. So put all that together, and Bloomberg Economics sees a pretty significant upgrade to 7.5% growth for the year. But park that for a minute, because what investors might be watching even more closely are inflation expectations. And Bloomberg Economics sees inflation tipping past the bank's 2% target. And if the bank agrees with that forecast, well, one economist told me it would be a super hawkish signal.
So, Lizzie, what about all this talk about tapering? Could we find out today when they start thinking about tapering?
Yeah, so this is the tightrope the bank's walking at the moment. Given how well the recovery's been going, everybody wants to know when and how the bank's going to take its foot off the stimulus pedal. Is it going to eke out asset purchases until the end of the year, or is it going to taper abruptly sooner? And if it chooses option number 2, investors are likely to see it as yet another hawkish sign that an interest rate hike is in the pipeline.
Lizzie, thank you so much. Lizzie Burden there, who covers economics for us at Bloomberg. Now, coming up, scandals and malpractice plague the modern corporate board, raising questions about their suitability for the 21st century. Well, Dambisa Moyo's new book tackles the tough questions facing boards. We'll be speaking to her next. It's a really good read. How can they work better in a very chaotic world? So we'll look at chaos in the business world and actually the board's duty on it. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Now, the G7 puts pressure on China and Russia to behave after the former suspends economic dialogue with Australia. Shares in Shanghai and Sydney slide, while the U.S. looks set to open in the green. The Bank of England is expected to make a big upgrade to its growth forecast while warning that it is ready to loosen policy if needed. The UK also holds regional elections across the nation. And stepping on the gas, VW raises its full-year outlook as market recovery boosts demand. We hear from our interview with the chief executive, Herbert Diess, about why he's not too worried about the global chip shortage. Well, good morning, everyone. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London. Now, this is Thursday, the 6th of May. We've also had a lot of banking earnings out of Europe today, including Societe Generale and UniCredit. So let's get straight to Danny Berger with the latest. Danny, what do you have for us?
Well, Francine, we're seeing these really strong trading results, specifically from the two you mentioned, SocGen and UniCredit. And I think this is somewhat of a surprise to the market. We saw Deutsche Bank do well. Their shares rose lots to the upside when that happened. And we knew the U.S. lenders had strong trading results too. But could Europe keep up? Well, they did. SocGen seeing its best trading results since 2015. UniCredit, yes, it's smaller, but trading also beat. Provisions also better at both of them. And UniCredit, the biggest amount of fees it brought in quite some time as well. So we're seeing both leading gains in terms of the bank stocking index, the stocks bank index. Of course, not all banks are created equal. And if you didn't have that big trading revenue boost to your earnings, you could look a lot like ING does, falling 2% today. And the issue with ING is because of negative interest rates, one thing that they're really trying to push, one thing they're really trying to get into their earnings picture is lending. But we're at this point in the economy where people have saved a lot of money, so they're not lending. In fact, they're depositing more. So that continues to be a sore spot for INGs, despite the fact, Francine, their earnings did beat today.
Danny, what details did we get about their plans to bring workers back into the office?
Well, for Europe, it's a little bit more disjointed than perhaps you'd see in the U.S. because it does vary region by region. Now, our Caroline Conan did speak with SocGen CEO earlier today and talked about their plans for their French staff. Take a listen.
On average, for most functions, there will be between 2 and 3 days a week working from home. So we will not come back to something similar to before the pandemic. We will adapt the way to work, and I think it's the right balance, and I think it's going to be very attractive for our staff.
It's really this flexible model we keep hearing from European banks. ING also talking today that half of the time they're going to have their workers in the office and the other half they can work from home. And this does compare to what we've heard from the likes of JP Morgan and Goldman Sachs, where they're really trying to get their workers back into the office. Perhaps that's cultural differences, but perhaps it's also just the fact that, especially in the US, you do have a lot of people vaccinated who perhaps can get back to a greater sense of normality. Francine.
Danny, thanks so much. Danny Berger there with the very latest on some of these banks. Now, the board, a mainstay of modern corporates, is under increasing pressure. Scandals at companies like GE and WeWork have generated ire towards those at the top of the business world. In her book, the former World Bank and Goldman Sachs economist Dambisa Moyo takes a look at how boards work and how they can work better. Well, joining us now is Dambisa Moyo, global economist and author of How Boards Work, How They Can Work Better in a Chaotic World. And I think today is publishing day, certainly in the U.S. So Dambisa, thank you so much for joining us. It's a great read. It's a short, easy read, but you go through very complicated and difficult questions. So I urge everyone to really try and pick it up. Dambisa, you have been on a lot of boards throughout your career. How are boards different now to what they were 10 years ago?
Well, first of all, thank you for hosting me. I think it's really important to set your question in context. We've had boards since the 1600s, and the mandate of the board has actually been fundamentally three things: focused on oversight of strategy, focused on hiring, and in some instances having to fire the CEO. And really, most recently, we've seen an expansive role around the cultural frontier. First of all, in terms of bedding down the importance of excellence and professionalism, but also much more focused now on this ESG, environment, social, and governance agenda, which has widened the aperture away from just the primacy of a financial shareholder into broader stakeholders like community, employees, and broader regulators as well as government.
Dambisa, a little bit, after the halfway book, you basically talk about 5 things that boards really need to watch out for. And this is, the global talent on war. This is everything to do with, I guess, protectionism. What is the blind spot for boards at the moment that you've seen at almost every board you work on?
Well, I think fundamentally boards have to be prepared not only to risk mitigate, as we've seen with COVID, but also to remember that even in the biggest downdrafts, whether it's with a pandemic or a financial crisis, or even more systemic risks like digitization, we always have to think about upside leverage and upside opportunity. We can't shrink our way to growth. And so we always have to think not just about downside risk mitigation, but also the upside.
Dambisa, what will change? How can boards change right now? Are they at least asking themselves the right question?
Absolutely. And if you think about what the role of boards has been over multiple centuries, especially as they continue to provide oversight to corporations, companies have been good citizens, both in terms of job creation, tax base, infrastructure, and of course, innovation, as we've seen with the rollout of vaccines. But that role is expanding. And I think we should be optimistic about a real intervention and support of the ESG agenda, whether it's climate change, worker advocacy, voter rights, aspects of obesity and worker pay and gender and racial discrimination being combated in a very aggressive way. So I do believe in terms of metrics and in terms of just the sheer gusto behind these agendas and focus, corporations are doing the right thing and moving in the right direction.
Dambisa, I guess a lot of the focus is, of course, on trying to stop, this short-termism that we see certainly in listed companies and work towards like longer goals. It's also better for the environment, focusing on ESG. How will the role of the board adapt to that?
Well, we are not just thinking about supporting the broader pledge of the Business Roundtable, which in 2019 expanded the role, moving away from just the financial primacy of the shareholder into broader stakeholders. We are thinking about really taking a lofty goal and taking it bit by bit apart so that we can actually be good citizen and support using metrics, measurable metrics that show some innovation, but also are able to match the dynamism of the global society, things that are changing perpetually. As a quick example, 6 months ago, I didn't anticipate that 6 months later, i.e. today, we'd be thinking about voter rights and some of the issues we're dealing with. And we have to have a flexible enough ESG system that will be able to address whatever issues get thrown at us in the next 6 months and beyond.
Yeah, this is, clearly laid out in Chapter 5, which is Innovate or Die, which, kind of fills, I guess, boards and chief executives really with angst. Is this about succession, Dambisa, or is it about, finding trends so that the company survives and thrives?
It's all aspects. In terms of the strategy piece, we've got to completely think about a world in which it could be more siloed, more balkanized, and therefore the model of globalization that we've used has to be reflected upon, and we have to adapt to a world where it might not be as globalized as before. With respect to the CEO, it's not just about vetting CEOs in terms of financial and operational performance. We have to think also about their ethics and their moral compass. And of course, more generally, we need to think about ethics at the board level and more generally in the organization. And I think ethics committee are something that I think about and talk about in the book as potentially being an area that we should explore in terms of being an additional committee at the board level.
Dambisa, thank you so much. Dambisa Moyo, global economist and author of How Boards Work. It's a cool read. She stays with us, and we'll talk a little bit more, of course, about the macroeconomy and some of the other questions that we look, even when it comes to inequality. Coming up, the unequal global recovery as wealthier countries are able to roll out their vaccination programs. There's a fear that some nations could be left behind. So what should companies do? We'll discuss that next with Dambisa. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the developed world is pushing ahead with plans to open up their economies. Many in Europe, the UK and the US are working on travel plans for summer. But at the same time, the hospitals in South and Southeast Asia are still full of coronavirus patients, and India could face another lockdown. An uneven global recovery could leave the gap between rich and poor larger than ever. So what should companies do? Well, Dambisa Moyo addressed that problem in a recent opinion piece for Bloomberg. Dambisa, I know you've always worked on inequality and actually also seeing the difference between some of the emerging markets and some of the developed markets. How has COVID-19 made this gap even worse?
I actually worry a lot that we've downplayed this argument of a K-shaped recovery, one in which we'll see a much more material widening in the difference in inequality between the highest and most successful countries versus lower income countries. The reality is it's a very challenged environment, continues to be in countries such as India, where herd immunity is not expected to be achieved before February 2023. So we've got a lot of work to do. And the reality of this is that we can't credibly expect to be out of COVID with respect to global trade, global travel, without making sure that this pandemic is fully annihilated all over the world. So we have a lot of work to do, and we do have to take that broader purview, whether it's at the public policy level or indeed at the corporate level, in thinking about how to address this issue.
But how should companies actually, and at the corporate level, how should they be thinking about this, especially in a time where actually, they're getting a lot of pressure from shareholders. It's quite tough to even deal with their own employees. What can they do to make the world a little bit fairer?
A couple of things that I talk about in the article on Bloomberg that you mentioned is we have to start thinking about broadening the definition of what an employee is. The notion that you can have a narrow definition and say, well, only full-time employees matter to us is foolhardy. We have to think now about subcontractors, suppliers, the implications for zero contract workers, not just in traditional compensation packages, but also in areas such as mental health that are becoming much more important. Beyond that, corporations are becoming much more called upon in terms of having to address issues such as ESG, and those are much more in the public realm that have much more utility, I think, beyond the sort of creation of jobs and building out of infrastructure and innovation that the world is expecting of companies.
Dambisa, how do you see the economy and actually the world we live in different post-COVID-19? We talk a lot about rebuilding better. Do you actually see that, or is there a danger that we're thinking we're rebuilding better, but actually we go to the ways that we used to have?
Well, Francine, there's so many macroeconomic trends that are in play right now. Things like deglobalization, the risks and the opportunities around digitization that could materially alter the global trajectory. I will say that if you look at IMF forecasts, they are already forecasting a slowdown in growth, which look much more similar to pre-2020. And that's slightly worrisome. It's partly because of the risk of inflation, but it also has a lot to do with structural factors such as demographics, inequality, climate change that are creating headwinds longer term. The last thing I'll just say very quickly is that we know from history, the Gilded Age in 1870 to 1900 in the US and what subsequently happened is that in these eras of great crises, they're usually followed by big progressive programs. And with the pledge from President Biden for a $6 trillion effort in terms of a stimulus, I think that we are going to see many more progressive policies and more taxation, more regulation, and perhaps more challenge to public sector companies.
Dambisa, thanks so much. Dambisa Moyo, they're global economist and author of How Boards Work and How They Can Work Better in a Chaotic World. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. US regulators have sent the strongest signal yet that stricter rules could be introduced after the GameStop frenzy. SEC Chair Gary Gensler says apps like Robinhood exploit game-like features to keep customers trading. He is also concerned that a deluge of transactions routed through a few big players is threatening competition. He's set to speak at a House hearing that's later today. Now, personal care company Honest jumped in its trading debut yesterday. Actress turned entrepreneur Jessica Alba says she has no plans to step back and is keeping a leadership role. Her stake in the decade-old venture she co-founded could be worth up to $130 million.
I'm so grateful for my Honest team, for my partner, Nick Vlahos. When he joined me, we put together a strategy around what we wanted to do, and we, worked very hard at making that strategy really come to life.
We're going to be focused on this brand and the ability to continue to extend this brand in a very methodical way before looking at and exploring anything from an M&A perspective. We're happy with the portfolio that we have and the ability to go even deeper and wider within the Honest brand.
Now, Uber is confident it can achieve profitability by the end of the year, but shares are falling in extended trading as a ride-hailing giant says spending on recruiting drivers will hit earnings in the second quarter. Bonuses and other incentives will reduce the rate Uber takes from fares by about 20%. And finally, it's fifth time lucky for SpaceX's newest and biggest rocket. After a string of fires and mishaps, the latest test flight of the Starship prototype was nearly flawless. It flew to an altitude of about 10 kilometers before making a controlled descent. The landing was only marred by a small fire that was put out just a few minutes later. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, the Bloomberg Big Take, how the global chip shortage is forcing car makers to get creative to keep production moving. Our interview with the VW Chief Executive Herbert Diess is coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We would be very happy if we could finish the year basically on levels of 2019. That would be our target. There's still a lot of challenge ahead of us because of semiconductor shortages. I think we could manage very well in the first quarter the general shortage, but the incidents in Japan and in America, they're going to hurt us now in quarter two. But over the year, we think towards the year end, we are hopeful to recover.
Can you quantify how much they're going to hurt in the second quarter? We've heard so far some pretty shocking numbers in the industry. Ford, for example, a close partner of yours, said 50% of its production will be cut in Q2 because the chip shortage is going to cost them $2.5 billion. What do the numbers, specific numbers, look like for Volkswagen?
Actually, I wouldn't give you numbers now because we are fighting day by day. We're going to be hurt, but not in that kind of magnitude. So we think we will see some lines stopping for a few days, for a few weeks, but not as brutal as the figures we see from some of our competitors.
Well, that was the VW chief executive, Herbert Diess, speaking to Matt Miller about the impact of the global chip shortage on his business. Now, Diess was quick to downplay the damage to VW, but some car makers have been forced to get creative to keep production moving forward. From Nissan stripping out navigation systems to Ram moving its intelligent rear-view mirrors from its pickups, companies are taking drastic measures to save on chips. Well, joining us now to discuss further is Tara Patel, who wrote today's Bloomberg Big Take about the chip shortage and its impact on automakers. Tara, first of all, it's a great piece, and actually it's a great new Bloomberg product, the Big Take, because it really allows reporters and anchors to delve deeper into something. How long will this last, Tara? We're seeing political pressure to actually ramp up some of these chips. Is it here for the rest of the year, or could it last 2 to 3 years?
Well, one thing that's become very apparent this week and last week is that the CEOs of the biggest automakers are saying right now they are in the absolute thick of it. The second quarter was flagged to be the worst, and it's proving to be the worst. There's rolling halts to assembly lines. Workers are being told from one week to the next whether or not their plant is going to be in operation or not. And what is probably even more worrying is that whereas a month ago they were flagging this quarter as going to be the worst and then things would be better, we've heard CEOs like the head of Stellantis yesterday talking about 2022 and that some of the effects will linger into next year. So it seems like these kind of bottlenecks are possibly going to get a little bit better, but the effects are going to reverberate much longer.
I mean, Tara, why is it so difficult, for countries to actually produce their own chips? If you look at, self-sufficiency, is it that difficult to achieve semiconductor self-sufficiency?
It's a very, very, very difficult operation. It's a very difficult product to manufacture, and it's a massively capital-intensive industry. And as with many crises, the damage is done right now. Countries and regions, Europe and the United States, are waking up to the reality that they've missed the boat on a lot of manufacturing capability, and that getting back into the game, less reliant on producers like Samsung and the Taiwanese, will be a very expensive and a very politically and long and arduous battle. And so I think there's a lot of questions being raised in political circles among manufacturers as well as how did we get here. But it will be very interesting to see in the months that follow whether any hard and fast decisions will be made and how to rectify the situation.
Tara, does this get worse as tensions rise with China?
This is, I think, with the chips we're seeing, but with all kinds of materials, these are, and the whole supply chain issue that has been thrown up by the pandemic, by the previous U.S. administration, trade tensions with employment and labor issues, especially in Europe. I'm based in a country in France where politicians are extremely focused on trying to bring back manufacturing, and that politicians are realizing that yes, the supply chains originated in China. There has been over the decades a huge amount of dependence that has been built into that country for supplying these kinds of equipment, and yes, it will be looked at.
Tara, thanks so much. Our Paris transport editor, Tara Patel. Now, Bloomberg Surveillance Early Edition continues. I'll be joined by Matt and Kaylee. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm willing to compromise, but I'm not willing to not pay for what we're talking about. I'm not willing to deficit spend.
If we continue to have very low interest rates, which I expect, I think it's going to be important to continue to be vigilant.
The market's going to be surprised because the Fed will raise rates sometime in 2022. They'll be forced by inflation.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Thursday, May the 6th. Our top stories today. G7 to China, play by the rules. The world's biggest economies call out Beijing over everything from alleged human rights abuses to incursions in cyberspace. Bezos on a selling spree. The world's richest person gets rid of $2.5 billion in Amazon stock and signals there's more to come. And what's bugging Volkswagen? Well, the automaker raises its full-year outlook but warns of the impact of the global chip shortage. We'll hear from VW's chief executive. There's a lot going on, a lot of stories actually that we need to look at, including pharmaceutical stocks. I'm really looking forward, Kelly, to telling everyone about that great Matt Miller interview, Volkswagen. Of course, underpinning everything is still the question on inflation.
Yeah, inflation, the chip shortage, definitely an issue, Francine. But to your point about some of those pharmaceutical stocks, they were under immense pressure in the Asian session as both the U.S. and EU are signaling they will back the lifting of IP rules for vaccines. Some of those Chinese vaccine makers seeking 20% or even a little bit more. That is one of the reasons the CSI 300 was down more than 1% after the holiday break. Another part of this story is the fact that China formally put an end to economic discussions with Australia. It was mostly a symbolic move, but still speaks to worsening tensions between the two countries, and Australian equities were under a bit of pressure as well. Japanese equities were the outperformer, and the Japanese yen, interestingly, was weaker against the dollar earlier, but now is just fractionally stronger, sitting at 109.24. In the European session, it was looking like it was going to be a pretty strong day. We saw gains across the continent earlier, but those are waning. Actually, the Stoxx 600 is now lower by about 0.2%, and the FTSE 100 in the UK has given up most of its gains as well. Of course, speaking of the UK, we do get that BOE decision coming up at 7 a.m. Eastern time, just about 2 hours. And ahead of that decision, the cable rate is essentially flat, sitting at 139. As for the picture here in the U.S., as the session grows older, we have seen gains in the futures market easing just a little bit, but we still are in positive territory. S&P E-minis up just about 5 points. Not a lot of action when it comes to the Treasury market, at least in nominal yields. The 10-year yield sitting just around 1.57%. But where my eye is on break-even rates, specifically the 5-year break-even, which gauges how markets are pricing inflation over the next 5 years. That is at 2.71%. The highest going back 13 years, all the way to before the financial crisis around 2008. And of course, a lot of that inflation story has to do with what we're seeing in the commodity complex. Matt, the Bloomberg Commodity Index higher for a 5th day in a row, sitting at its highest since 2015, Matt.
You know what the crazy inflation story is? In the Bezos story today, you can see that from 1997, he sold about 1/5 of Amazon for roughly $2 billion over a 15-year period. 1/5 of Amazon today would be worth $320 billion. That is legit inflation. I mean, he's rich enough, and as we'll talk about it in a moment, he's been raising more money as well. But still, that's incredible. Let's take a look at what's going on today that you should be paying attention to. Kaylee was talking about decisions at 7 a.m. New York time. We're going to get rate decisions from Turkey as well as from the Bank of England. We'll be all over that this hour. At 8:30 a.m., U.S. initial jobless claims. And, of course, that leads up to the big NFP number on Friday. And then at 11 a.m., don't miss our interview with the Bank of England Governor Andrew Bailey. That'll obviously be after the decision, so we'll get to really dig into it with him, Francine. But is it Thursday? It's Thursday already. I cannot believe. Is it? Am I wrong about that?
It's Thursday.
Is it Thursday?
Yeah, I thought it was Thursday yesterday, but that's because
amazing.
I had a day off on Friday because of the bank holiday. It's amazing how time flies.
You've got elections today as well, right?
We are, and we're very
elections
restricted
all over the
in
place.
what we can what we can talk about, but we'll, start having the results a little bit later.
Calendar
but certainly
item.
it's local elections, but could give us a very clear idea of what people want and whether, they like the current politicians or not. Now, Jeff Bezos, as you're saying, this is one of our favorite stories, selling $2.5 billion of Amazon stock. It's his first big disposal this year after offloading more than $10 billion worth of shares in 2020. Let's get more now with our Danny Berger. Danny, what else do you have for us?
Well, Matt stole my favorite fact of the day, but it does really just show how much Amazon has rallied. He doesn't need to sell a lot to get billions of dollars worth of proceeds. So this sale, it was about 740,000. He has an option to sell 2 million more shares. And then we get to the point where he sells just nearly as much as he did last year when he got $10 billion back. Now, the thing about when executives sell shares, it is something that investors tend to look at with raised eyebrows because it could mean that they have questions about the direction of the stock. They're less confident. But look, we don't get that effect with Jeff Bezos. Most of his wealth is wrapped up in the shares themselves. And typically, he does use the share sales and puts it into his space company. So it's more sort of a funding project than it is, anything about nerves of Amazon. And that's reflected in the share price today. That's more or less just slightly higher pre-market.
Well, talking about share prices, Danny, I want to pivot elsewhere in tech. I'm looking in pre-market trading. The ARK Innovation ETF down 0.5%. This would be the 8th down day in a row. What is going on with Cathie Wood's fund?
Yeah, I guess Bezos isn't the only one selling tech, but as you say, another down day for its performance. And yesterday was the 6th consecutive day that we saw outflows out of this fund. This is the daily fund flow. So 6 days, easily a record for this ETF. And that's significant because the fund flows here tend to be very sticky. This is a cult favorite. People like ARK, and it just shows some of the sensitivity and vulnerability of these bigger high value names. But look, ARK funds in general have still brought in more than $15 billion so far this year, which is impressive considering 7 out of 8 ARK funds have underperformed the market. So as our ETF guru Eric Balchunas puts it, this is more just ARK mania fading, which might be something that the fund would want to see anyway.
All right, so ARK inflows are just a little bit more than Bezos has made from Amazon sales in the last 18 months. Danny Berger there on a couple of hot stories that we're watching. The meeting of G7 foreign ministers in London has ended with a joint communique that singles out China over a variety of subjects. It comes as China has announced it's suspending an economic dialogue with Australia. So a couple of big geopolitical issues there. Let's get more from Bloomberg's Maria Tadeo in Brussels. Maria?
Yes, Matt, and when you look at the language and that communique, some pretty strong words. They say the G7 is concerned about human rights abuses. They also worry about labor abuses and the treatment of minorities by Chinese authorities. By the way, the Chinese have already responded to this communique, saying the G7 should focus on dealing with the virus and not meddle in what they believe are internal matters for China to deal with. Now, when you look at the actions, well, there wasn't a lot of that. So the language is tough, but not a lot of action on that front. Again, is this problem of very tough language, but not a lot of action given that you want to separate the politics from the business. The one area where there could be trouble ahead, however, is the EU-China deal. Remember, Matt, this was a deal that was signed at the end of last year. The Germans were pushing for this, but now it needs to be ratified. The EU says it's in no rush to do that, so it could take years before that deal materializes now.
All right, Bloomberg's Maria Tadeo, thank you so much. I do want to take a look at a few stocks on the move now. Both CureVac and BioNTech are under immense pressure in European trading, and the ADRs are under pressure in the pre-market session as well. BioNTech down about 7%, CureVac by 5% in early hours. That's as the EU signals it will back a U.S. proposal to waive intellectual property protection for COVID-19 vaccines. And as far as earnings movers go, Uber reported its first quarter results after the bell last night. The backward-looking view was solid, but the forward-looking one is the issue. The company saying spending on recruiting drivers will impact earnings in the second quarter. There's some regulatory concerns at play as well. That stock down about 3.5%. And also plunging is Rocket, the mortgage lender. Loan origination volume sinking in the first quarter, and it forecasts a further decline in the second. That stock down a whopping 14% before the bell, Francine.
Thank you so much, Kaylee. I've gone down the rabbit hole of using my Bloomberg terminal to check out what would give you the best return if you had invested in 2015. So bear with me. I'll also enroll some help from Daniel Curtis. Matt, look at what you've done on a Thursday morning. We're like trying to figure out what would be the overall best investments in the last 6 years. Coming up, Karen Ward, JP Morgan Asset Management Chief Market Strategist. We'll talk to her about some of the industry and groups that we're watching. And then a little bit later, we'll also be speaking with the Bank of England Governor, Andrew Bailey, after its rate decision. Look for that interview at 11 a.m. in New York, 4 p.m. in London, and this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lines in New York. Now, we are awaiting Bank of England, a number of central bank decisions actually, but the Bank of England decision specifically, and I'd like to put into context the amount of quantitative easing that's been used in the coronavirus pandemic versus some of the other crises that we've seen in the past. For those of you tuned in on London DAB digital radio, what I'm showing here is the amount of money the Bank of England has spent. In the financial crisis, 2008, 2009, we're looking at about £200 billion, a little bit less for the EU sovereign debt crisis, but not too much less. Brexit was far less than £100 billion in purchases necessary, but now we're looking at almost £500 billion of spending from the BOE during the coronavirus pandemic. And I want to know how much more it's going to be, or if they can afford to start tapering. Joining us to talk about this and much, much more is Karen Ward. She is Chief Market Strategist of EMEA at JP Morgan Asset Management. So Karen, as we see the economy really taking off in the UK, does the BOE need to start tapering, or at least thinking about tapering and telling us about it?
I don't think they need to be too specific just yet. I mean, don't forget, the way the Bank of England has done things is rather than tell us they were going to provide a constant weekly purchase rate, they gave it to us in chunks. So in November, they said they were going to make 150 billion of purchases. And so they naturally have a taper program built in. The only question is how quickly through the course of the year they will taper. I don't think today they need to specify that. Yes, it looks really good so far. We're seeing a strong bounce back in the business surveys, but it's still pretty early days. And I think particularly over the next few months, we need to see what happens in the labour market and how the furlough scheme is wound down and what happens to unemployment. If we get, towards September and it's clear that the furlough scheme was a resounding success and we've still got unemployment close to 5%, then it's at that point, I think the Fed, the Bank of England, central banks on the brain, can really start to give us some idea of a tightening schedule. But for now, I think they can just wait.
But Karen, overall, good morning to you. Who's the G7 central bank or the major central bank that will taper first? And does it matter if it's the Bank of Canada or if it's actually the Bank of England?
I think it does matter, Francine. I think it's a really good point. I think the Fed are setting the agenda, and it's important because of the currency implications. So I think the risk for the Bank of England, if they don't take their cue from the Fed, is that we have an adverse tightening of sterling as the interest rate differentials for the UK change relative to the US. And I think now is not the time for the UK's exporters to be coping with a higher exchange rate, given everything else that they're dealing with, COVID, supply issues, Brexit, new trading relationships. So I think actually a focus on the role of the currency through the recovery is going to be important. And that means the bank have got to somewhat follow the Fed, which of course is what the ECB have told us pretty recently.
Karen, overall, when you look at some of the things that we look in the markets, and I'm not sure what to do with the commodities boom that we're seeing. Is it linked to an overheating economy, or is it just wildly different from the super cycle that we saw last time around?
I think there are elements of both. I mean, I think it partly relates to the speed with which demand is coming back relative to supply, and some pretty material bottlenecks that are in the system. So I think there's a cyclical aspect of it. I think the secular aspect of it and the sort of super cycle aspect of it is the transition from traditional fossil fuel energy towards renewables. But actually, so much of the infrastructure upheaval is going to have quite significant other commodity implications because of some of that infrastructure that's going to be required to move us from A to B. So I think it's aspects of both.
Karen, you mentioned cyclicality there, and another place that people are looking to capture cyclicality, capture some value, is Europe, and it seems people are increasingly pivoting toward the continent. But when we talk about the European growth story, if that also translates into higher bond yields, a stronger euro, is that necessarily going to be good for European equities?
Yeah, great question. So there's a few things there. I think, first of all, we've got to be, as investors, really careful not to overinterpret the macro into the markets. For me, the dominating theme right now is what's going to happen to the sectors. Last year was all about the sectors. You wanted to be heavy tech, and therefore you wanted to be heavy the US. You didn't want to be heavy financials and energy, and therefore you didn't want to be heavy or overweight Europe. As we look forward, it's still that sectoral story that's driving. And I think it is a catch-up, a rotation story. So I think the outlook is good for the financials as those curves do start to steepen. I think it's good for aspects of other value components of the bucket where Europe is relatively heavy, as well as the industrials and the ESG theme, where many European companies are at the frontier. With regards to the euro, I think we overplay the headwind that the euro plays towards European stocks. If we look pre the sovereign crisis, you had a period in which the euro rose really strongly. That was when we were up at 130 kind of numbers against the dollar. And it didn't provide a headwind to the European markets at all. And it's because both the markets and the currency and the bond markets were reflecting what was a much stronger macro backdrop. So I'm not too worried about the currency. And I do think that rotation really favors Europe, or certainly a big thing that I've been saying to clients is really thinking about rebalancing away from the winners of last year.
You know, we've seen the ECB for a time really held bond yields between negative 50 and negative 60 basis points. It was very focused on that, and they've let them slip back up recently. Right now, the 10-year bond yielding just about negative 23 basis points. Does it continue to rise back towards zero? Is this no longer a focus for the European Central Bank?
I think for the ECB, it's really what the macro is going to justify in terms of where these yields should head. Now, I think as we move through the second half of the year and confidence in a strong recovery on the continent starts to grow, and I think that's partly a domestic vaccine story, but it's also partly how Europe will be a key beneficiary of the pickup that we see elsewhere. I mean, the US stimulus, some of that will leak, and about 22% of US imports come from Europe. So I think you're going to get that global recovery as well as a domestic recovery pointing towards a stronger nominal outlook. And I think that just makes the ECB a little bit more comfortable with across the region, those yields starting to lift up. But I think they're going to want it to be gradual and measured. We've heard Ms. Lagarde, constantly stepping in over the past year, just saying, temper that, calm down, and leaning back on those yields. And I think that's going to be a theme, probably not just for the ECB, but for central banks everywhere, where the market's trying to react to stronger nominal growth and the central banks leaning against them.
Thank you so much, Karen Ward, there, Chief Market Strategist, EMEA at JP Morgan Asset Management. Now, a little bit later on Bloomberg Surveillance, Nobel laureate and economics professor at Columbia University, Joe Stiglitz. I'm looking forward to that conversation. He's usually very good on inflation, but also on the euro. That's at 8:30 a.m. in New York, 1:30 p.m. in London, and this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
We're also seeing a really strong recovery.
No one delivers the data faster.
Nestle's out with numbers. Can this company continue at this kind of clip?
Bloomberg Television, your home for earnings season.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get to the first word news, and SpaceX nailed the landing in the fifth test of its Starship rocket. After reaching an altitude of about 6 miles,
Starship heading back to the landing zone
to its launch pad in Boca Chica, Texas. SpaceX founder Elon Musk sees the rocket as the future workhorse for trips to the moon and to Mars. NASA recently picked SpaceX to develop a moon landing system with Starship. President Biden says he's open to compromise on raising the corporate tax rate. The president has called on Congress to boost the rate from 21% to 28%. But now he says it doesn't have to be exactly what he says. Democratic Senator Joe Manchin has said he could support a 25% corporate tax rate. And the EU is willing to discuss a COVID vaccine patent waiver, according to European Commission President Ursula von der Leyen. The plan is already backed by the U.S. Drug makers are opposed. They say few countries have the capacity to make the vaccines, even if they knew the formulas. And Matt, speaking of drug makers, we saw vaccine maker shares under pressure in the Asian session. They are under pressure in the European session and in the pre-market session here in the U.S.
Yeah, I mean, the idea that they're not allowed to keep the IP, I don't know why that was such a surprise for shareholders when you're in the midst of a global pandemic and so many people are dying, millions of people are dying. You're going to want to share the recipe for the cure with the rest of the world, or at least for the vaccine, right?
Yeah, I spoke to Arsene Fazeli earlier, who's saying, he's not sure this will happen, and certainly we're going to have some very difficult conversations on this at the World Trade Organization. Now, coming up next, it's Europe's largest online fashion retailer by sales. We'll be speaking to David Schroeder, the Chief Financial Officer of Zalando. This is Bloomberg.
Our focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
Friday is Jobs Day on Bloomberg Television. Will unemployment move lower, and how will markets react? Plus, special guest, Minneapolis Fed President Neil Kashkari. The April Jobs Report, Friday morning on Bloomberg Television and Radio.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman in London, Matt Miller in Berlin, Katie Lyons in New York. Now, we're looking at the markets away from our songs and our singing, Matt. We look at the markets underpinning everything, of course, is inflation, but we look at pharmaceuticals because of this intellectual property proposal that the U.S. seems to be behind, which means that they waiver it. And then we look at commodities and technology.
Yeah, I'll make an admission that during the break, I said that I actually like the band Nickelback. In fact, I love Nickelback, and it seems like a difficult transition to go from Nickelback to IP. But well, to markets, that makes sense. They rock the markets. But the IP question, I think, is a really interesting one. You know, as I said before the break, if you have a cure to something that's killing millions and millions of people in the world, it seems to me clear that you're going to have to share the recipe for that cure at some point. But I guess we'll see how the World Trade Organization thinks about that. It would only be fair, wouldn't it? Wouldn't it?
Well, it's certainly be very good for inoculation programs and for humanity. Kaylee, I mean, that's kind of playing out on the markets and the margin when you look at pharmaceutical stocks. But then there's, you know, we also have the Bank of England. Today's like a lot of stories that kind of don't really merge into one.
I know, and there's so much going on, and I'm trying to keep my brain focused on it, but also Nickelback is now just playing in the back of my mind. But to your point, Francine, we have a number of...
The intellectual property of Canada.
Yeah, okay, great attempt to tie that into the market conversation, Matt. But in the markets, we are seeing a number of vaccine makers under immense pressure. But when you look more broadly, we're also seeing things lose a little bit of steam as well, actually on both sides of the Atlantic. After being higher earlier, the Stock 600 now down 0.5%, and S&P 500 futures have flipped into negative territory, now down about a point. So it's getting more risk off as the session grows older. In foreign exchange, we are awaiting that BOE decision at 7 a.m. Eastern time, which Francine mentioned. Ahead of that, the cable rate just fractionally stronger, sitting at 139.16. I also am watching the bond market. Not a lot of action in nominal yields. The 10-year yield sitting just around 1.57%, but keep an eye on break-evens, that 5-year break-even rate at the highest since 2008. As for some individual stocks on the move, we talked about how vaccine makers are under pressure. That is one story. There also, of course, are earnings that are continuing to roll out. PayPal reported after the bell yesterday a beat and raise quarter. The stock is up about 4.4% as a result. And those results indicating people are going to keep shopping online, paying for things online. That's good news for Square as well. It reports after the bell tonight, but is up about 2.4%. Before the bell, Zynga, a mobile video game maker, is also higher. Its forecast beat. Part of that has to do with a $250 million acquisition it just announced of a mobile ad platform. That stock up about 2.5%. But plunging to the downside is Etsy. Its forecast came up short. Apparently not a lot of people going to be shopping on Etsy going forward. Morgan Stanley saying investors really overestimated how long that 2020 momentum was going to last, and that stock is lower by 10% before the bell, Matt.
I'll tell you what, I don't want to shop anywhere anymore unless they deliver immediately. I need my stuff like within 24 hours. And if they can't do that, I'm not going to pull the trigger. I have actually my erstwhile producer and Bloomberg's very own queen of charts, Hillary Clark, put together a great chart for me. And for those of you listening on radio, this is a chart that you already have in your head anyway, because you know it goes back to the early 90s. It shows the rise of online shopping. You know, you've been doing a lot more of it over the last couple of decades, but especially over the last 12 months. It's just jumped to almost eclipse brick and mortar shopping in the heart of the pandemic. The question is, how much of that is sticky? Surely a lot of that, Francine, is going to stick, because if you've now subscribed to, paper towel deliveries or Jif peanut butter deliveries every few weeks or what have you, you're not going to unsubscribe. And if you've gotten used to buying your spark plugs online, you're not going to go back to AutoZone to get them.
I mean, that's $1 million question, and that will have huge implication for some of these online retailers. I'm mean to my children because they're a bit like you. They, if something takes more than 24 hours to arrive, they freak out, and so I make them wait on purpose. I sometimes use Prime and then just say, hold off, it's not here yet, and I will not give them the time. Harsh. Let's talk about online retailers, and Europe's biggest online clothing retailer is seeing a boom from the pandemic, as Matt was just showing with the charts. Zalando grew at the fastest pace in the first quarter since its IPO and raised its earnings outlook following exceptional, strong, and profitable growth. We are delighted to be joined by the Zalando Chief Financial Officer, David Schroeder. David Schroeder, thank you so much for joining us. Can you give us a little bit of a glimpse of what exactly has been doing really well on Zalando? Is it people working from home, buying hoodies? What kind of things flew off online?
Thanks for having me today. We've also obviously seen quite some acceleration in the market dynamics, both on the consumer side, but also on the brand side, as the fashion industry has been particularly challenged by that pandemic. And I think in terms of consumer demand, we've mainly seen it play out in two things. First of all, many more new customers joining our platform, but also those customers that join our platform, and the ones that are with us already shopping different categories. So we've seen a rise in the share of all the need-based categories, leisure wear, kids, sports, and also beauty, whereas occasion-based categories such as dresses or formal wear have obviously been on a decline given the lack of occasions.
So how do you see it as more people get vaccinated in Europe? And Central Europe is definitely far behind the UK and certainly the US. But when you look at how this pans out, so when people get vaccinated, do we go back to buying online and in store, or do we just continue buying online like the pandemic?
Well, I think what we are seeing right now is that there's still some accelerated demand shift from offline to online. That's probably due to the third wave. And as you said, also not the same pace of vaccination across Europe. But what makes us very confident also for the time later this year, especially for the second half, is that in all the markets where we are further ahead, but also in all the markets where we saw some relaxation between the first and the second wave last summer, we've seen continued strong traction with our customers. And that, I think, gives us an indication that although things hopefully will reopen soon, customers will still heavily spend online and hopefully also be very active on our platform.
David, I'm on the gram, by the way, obviously, at Matt Miller 1973, and that's really one of the places Zalando gets me. Really well-targeted ads, really just the stuff that I want. I can just click out of there and buy it. I wonder how much that costs you, that kind of targeted marketing. How much of a piece of the budget is that?
Well, I think, first of all, it's important to understand that we really want to be that starting point for fashion for you, right? So just like you said, we want to be the place where you naturally start your fashion journey and you just know whatever you're looking for, you'll get it. And we understand you better than any other platform. And that's why we put a tremendous effort in building great customer experiences, but we also obviously invest into customer acquisition. And if you look at our spending in marketing, it's been in the high single digits of revenue over the past years.
Looking at one of your warehouses here, and I don't know if it's just Berlin or if it's globally, everybody I know seems to want to work at Zalando. How is that situation going to look when we get vaccinated, when we come back? Is it going to be different working at Zalando in 2022 than it was in 2019?
Well, obviously, the pandemic has had a tremendous impact on the team. If you just look behind me, you will see an empty headquarters, right, which is really hard to get used to. And so we all hope that we'll meet here again soon in bigger numbers. But I think the team has also shown that we are really resilient and we can quickly adapt to the new circumstances. So we pulled off tremendous growth, faster growth than ever before, at a time where everyone all of a sudden had to work remotely. And I think that shows really the strength of the team and also the culture, which for sure we'll continue to leverage also after the pandemic. What we'll definitely see, though, is more flexibility and definitely a higher share of remote work also at Zalando, because I think we are all learning that this is valuable and also possible. And for sure, that's also going to be important for our talents in the future.
David, you're also going to build out 5 new fulfillment centers in Europe by next year. Where else are you going to put capital to work? Can you put more capital to work than you are right now?
Sure, and we have to, right? Because we just recently in our Capital Markets Day in March communicated a increased midterm ambition to grow to 30 billion in GMV by 2025, essentially tripling the company that we were last year. And that ambition will require significant investment. We'll mainly invest into our infrastructure, namely the logistics network, but we'll also heavily invest into our technology platform because that's what ultimately drives the best customer experience in fashion and also all these great services that we can offer to our partners to participate in the great success of our platform.
Thank you so much, David Schroeder, there, the Zalando Chief Financial Officer. Now, coming up, the global chip shortage is forcing car makers to get creative. We get the outlook from the Volkswagen Chief Executive, Herbert Diess. Matt Miller did a great interview that will be coming up shortly. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We would be very happy if we could finish the year basically on levels of 2019. That would be our target. There's still a lot of challenge ahead of us because of semiconductor shortages. I think we could manage very well in the first quarter the general shortage, but the incidents in Japan and in America, they're going to hurt us now in quarter two. But over the year, we think towards the year end, we are hopeful to recover.
Can you quantify how much they're going to hurt in the second quarter? We've heard so far some pretty shocking numbers in the industry.
Good morning, day traders. Hope you did get good evening yesterday. If you're ready to place an order, I'm looking to buy Bitcoin. So what do you think about Bitcoin? If you want to follow my trade and if you're planning to trade Bitcoin, the price I'm looking to buy 57,038. I'm looking to buy Bitcoin at 58,038. Okay, just right here. I will adjust later on. So you still have time. If you want to trade Bitcoin, here's your chance. You can place an order and then stay with me, and we will go through until the end of this trade. Okay, I'll speak to you later, guys. Stay safe. You still have time to place an order.
To invest in electric, to be able to invest in software, maybe even make their own chips at some point. So this is really important. The cash generation that they're going to need to spend is happening, and they're not going to need to IPO Porsche, maybe even not going to want to until next year at the earliest. Let's get over to Tara Patel. She wrote today's Bloomberg Big Take about the chip shortage for us, and its impact on automakers has been really clear. Tara, is anyone getting away with this better than others? Is anyone getting hit harder than the rest of the group?
I think that in terms of car makers, some of them may be coming out and stating, giving, like Ford, some of the more shocking guidance to the market about just how hard they're going to be hit. But I think all of them are really feeling the pain. Earlier, we heard VW CEO. Yesterday, we were listening to their big rival, Stellantis, talk the same kind of talk. Assembly lines are being halted. They are doing battle, fighting for chips. And they're in this quarter, it's the worst that it's going to be this year, they're predicting.
Tara, so we have a big take, which is a new Bloomberg property that basically delves into something featurey. It's, I think, a fantastic proposition. And today, what the big take is a question that we've been asking and trying to get to the bottom of, which is, if there's a chip shortage and it keeps on getting worse, why can we just not produce more? Well, I think the real answer is that, as in with many crises, is that right now the damage has already been done. This kind of industry is hugely capital intensive, extremely complicated, highly technical products, and it's not something that people just decide to invest in and then they'll be making their chips next year. Supply chains have deep roots and they've been honed over the decades, and so it's really just not that simple.
And of course, if this is a longer-term problem, automakers can't just sit and wait for it to fix itself or to get fixed. They have to take action now. So what's the solution? Is it just focus on more profitable cars, put your chips into cars that are going to get you a higher margin?
That's part of the solution, and that's what they're doing. That's what many automakers have said. We are focusing on the cars we can make the most money, and they're also coming up with little tweaks. That is to take Peugeot, Stellantis was saying they're putting analog speedometers, the old-style speedometers, back on a small hatchback model, so that they can save chips for another model. Another option that is being removed by Nissan and other automakers is for built-in navigation systems, which use a lot of chips. And this is something that consumers will get a break. A lot of car makers are saying, okay, if you don't get the higher tech, you can get a discount on your car. But that also means that that automakers will, it might hurt their margins as well.
You know what's funny is that I would prefer an analog speedometer and tachometer, and I would prefer, if you buy a 911 GT3 from Porsche, you have to pay more to have the navigation system taken out. That's an option that costs you more. So I think that's, at least for me, that would be brilliant.
But is it more breakable, Matt? Is that why they do it this way?
You just... If you buy a car, and maybe it's not the same with a Nissan as it is with the GT3, but if you buy a car that you want to hold on to forever and pass on to your daughter eventually, you don't want the navigation system in there because it's going to end up looking dated, and everybody uses a phone anyway.
True.
There you go. All right. You've heard it here first. News you can use. This is what you need to buy if you're going to pass the car to your daughter. Our transport editor in Paris, Tara Patel, thank you as well. Now, vaccine stocks falling in pre-market trading as the EU backs a plan to discuss waiving vaccine patent protection. So we'll have more on that story. We'll look at the market reaction as well. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. While pharma stocks are under immense pressure today, and this is after the EU said it's willing to discuss a COVID vaccine patent waiver, according to European Commission President Ursula von der Leyen, and that plan is already backed by the U.S. Sam Fazeli is a director of research at Bloomberg Intelligence, and he joins us now on the phone. Sam, what would be the real impact on these companies? Of course, it's still an if, but if it happens, what's the read?
Yeah, good morning. So I think the impact would be if this becomes a reality, and I don't mean in terms of the reality of waiving the patents. I mean the reality of countries being able to pick the patents up and actually manufacture vaccine at volume, safe vaccine at volume. Let's say all that happens. There would be, the impact for me would be on the long-term durability of the revenues for the vaccine. So 2023 onwards, it will take some time for competing areas to develop vaccine. And also, it also depends on whether they release these, apply the waiver to which countries. If the West still has to buy from Pfizer and Moderna, then that business is still there.
So, Sam, I understand this is now going to WTO. How thorny will the negotiations be? And actually, will it hurt creativity? I mean, not creativity, but will it hurt new vaccines in the future if this is a new business model? Or should this be the good thing to do for the sake of humanity?
It's very, very hard for me to stand here and say there should be things, they should not try ways of increasing the volume of vaccine available to the world. We all need that. The issue that WTO has to think about is, will we be able to then, next time when there is a situation like this, what's the incentive for a company to spend billions of dollars? Forget Moderna, who got money from the US government. What about Pfizer-BioNTech, who is actually manufacturing the highest volume of vaccine? Will there be an incentive to do this? Will investors put money in their pocket to start these companies if they know this is a risk coming forward? This has to be carefully measured, very, very carefully measured.
Yeah, I guess the question is, if they say no, then does it put investors off? Sam, we'll get you back on to talk about this because it merits a lot more time and it's a difficult discussion. Sam Fazeli there of Bloomberg Intelligence. We have a lot going on today. Kaylee, what are you watching?
Well, I'm watching initial jobless claims data at 8:30 a.m. Eastern time. We could be looking at yet another fresh pandemic low. At least that's what economists are expecting, looking for a weekly print of about 538,000. But of course, this read is all the more important because it comes ahead of tomorrow's jobs report. So we're really just looking to see if the pace of improvement in the labor market can continue to improve as the economy reopens. And remember, Matt, that jobs report tomorrow is for what happened in April. So this read this week won't count. But still, we could be looking at a 1 million print on non-farm payrolls gains tomorrow, Matt. It could be a blowout number.
Yeah, and by the way, I will remind viewers, Kaylee, as well as listeners, that on the Bloomberg you can type WHIS GO and submit your guess. I always love that function, Whisper Go. I was blown away this morning to hear Volkswagen say they want their Bugatti brand to join forces with Rimac. Rimac is an Eastern European electric car company. That's a Bugatti Chiron, by the way. It can go just about 230, 240 miles per hour. It pushes the envelope for the brand. So it's so important, it pushes the envelope for the whole company that they get electrified, and maybe Rimac is the way to do that. The question is it a sale or a purchase?
I'm looking at the Bank of England, so we're expecting them to stay on hold, but actually it's all about the forecast. So we're expecting them to also have a huge upgrade in forecast, but it may be too soon to even sound hawkish. So it'll be interesting in the press conference and then in the interview with Bloomberg afterwards to see how the governor balances that out. I spoke to Bloomberg Economics earlier saying that the BOE could actually stay on hold this year and into 2022 as well.